All right, let's get into it. Today we're going to tackle a masterclass on trading breakouts. If you've ever felt like the market is playing games with you, this is for you. We're going to show you exactly how to turn the tables.
How many times has this happened to you? You see the price breaking out, you jump in, you're excited, thinking this is the big one, only to watch it whip right back around, knock you out of your trade, and then take off in the direction you predicted, just without you on board. It is one of the most maddening feelings in trading, right?
But here's the thing. What if I told you that it's probably not bad luck? More often than not, it is a perfectly designed trap, set by institutional traders to do exactly that, catch retail traders on the wrong side. But the good news, the really good news, is that once you see how the trap is set, you can not only avoid it, you can actually use it to your advantage.
So first things first, let's really dissect this breakout trap. To beat it, we have to understand exactly how it works, and more importantly, why it works so well.
In a perfect world, a breakout looks exactly like this. The price just shatters a key resistance level or breaks down through a solid floor of support. All this momentum kicks in and whoosh, it just explodes in one direction. That's the dream, right? That's the move we're all hunting for.
But, as we all know from painful experience, it's rarely that simple. So what's the deal? Why do most of these setups that look so good on paper actually end up failing? Well, it usually comes down to a few critical and very common mistakes.
These mistakes really boil down to three main things. First, chasing the move. We've all been there, just pure fear of missing out. Second, trying to swim against the current, fighting the market's dominant trend. And third, and this is a big one, trading weak setups that just don't have enough gas in the tank to begin with. Let's break them down.
Okay, let's talk about that giant, explosive candle, the one that gets your heart pounding. That is usually not an invitation to buy. It's bait. Seriously, what's really happening is the smart money. The big institutions, they're using that excitement to unload their positions onto retail traders who are showing up late. Chasing that candle means you're getting in at the absolute worst price, right as the professionals are getting out.
The second mistake is fighting the trend. The best analogy is this. Trying to trade against the main trend is like trying to paddle a canoe up a raging river. It's completely exhausting, and you're fighting this massive force that's probably just going to overwhelm you. But trading with the trend, that's like floating downstream. The current does all the work for you. Everything is easier.
And finally, there's trading weak setups. See, a breakout needs energy. It needs fuel. If the price has only been consolidating for a short little period, say 20 or 30 candles, it just hasn't had time to build up the pressure it needs for a real move. It's like trying to launch a rocket with no fuel. It just fizzles out on the launch pad.
So, if chasing is a trap and weak setups are duds, what's the answer? Well, this brings us to the secret weapon for finding high-probability breakouts. It's all about learning to identify something called a price buildup.
So what exactly is a buildup? It's a tight little consolidation that forms right up against the breakout level. Instead of price bouncing wildly back and forth, it gets quiet. It starts hugging that ceiling, coiling up tighter and tighter like a spring. That is your signal. That's the market telling you a real, sustained move is being prepared.
So why is this little buildup so powerful? Think of it like a pressure cooker. As price gets squeezed in that tight range, all the sellers are placing their stop-loss orders just above that resistance level. The longer it stays there, the more of these stop orders pile up. And when the price finally breaks through, it triggers that huge wall of stops, which are actually buy orders, and boom, that's the rocket fuel that creates the explosive move.
Okay, so that's the why behind the buildup. Now let's get to the fun part, the how. We're going to lay out the actionable step-by-step strategy to actually trade this.
And you're going to love this. The strategy is beautifully simple. It's just 3 steps. First, you find a market that's been in a consolidation range for at least 80 candles. Second, you wait patiently for that tight price buildup to form near the edge. And third, you use the 20-period moving average to help you time your entry almost perfectly. Step 1 is all about patience. We are looking for a range of 80 or more candles. Why so many? Because the longer the market is trapped and goes sideways, the more tension, the more pressure builds up. This is what separates a major trend-changing move from just another fakeout. Okay, once we've got our long range and we see that price build up, we need one final confirmation. And that's where our timing tool comes in, the 20-period moving average. Honestly, think of it like a traffic light. We just wait for that moving average to slowly catch up and touch the lows of the buildup. The moment it does, that's our green light. That's the final signal that the momentum is ready. Now let's talk about execution, because this is key. You don't just jump in. Instead, you place a buy-stop order, which is an order to buy only if the price moves up to a certain point, just above the highs of that buildup. You make the market prove itself to you. And your stop loss, that goes just below the low of that same buildup. This gives you a really tight, defined risk. The logic is simple. If the breakout is for real, the price has no business coming back down to that level.
All right, you've got the core mechanics now. Let's put this all together into a simple playbook, and I'll even add a couple of pro tips to help you refine this approach even further. And here's that pro tip. The 80 candle rule isn't totally rigid. You can adjust it based on the context. For example, if you're trading with a really strong dominant trend, the market already has a ton of momentum, so you might only need a 40 or 50 candle range. But if you are trying to catch a major reversal against the trend, oh yeah, you absolutely need that 80+ candle buildup. You need overwhelming proof that the power is shifting.
So where does this strategy really shine? Two scenarios are just incredibly powerful. First, breakouts to new all-time highs. Think about it. There's no overhead resistance, no old sellers waiting to dump their positions, just blue sky. A buildup there is a sign of massive strength. And second, major reversals. When you see an 80+ candle range with a buildup forming on a major support level from a weekly or even a monthly chart, man, that is an A+ textbook setup.
So let's just recap the entire playbook real quick. Stop chasing big green candles. Always try to trade with the dominant trend. Demand a long consolidation, especially for reversals. Wait for that tight buildup. Use the 20 MA to confirm the timing, and always place your stop loss right below that buildup for super tight risk. That's the recipe.
And that really brings us to the final and most important question. You have the playbook now. You know how to spot the trap, and you know how to find the high probability setup. So the only question left is, will you have the discipline to actually follow it? Will you keep chasing the market out of fear and emotion, or will you develop the patience to let these A+ setups come to you?